Good morning, everyone. How's everybody doing? Hey, Joe. How are you? Ian, how are you? What's up, Badir? Raj, how are you, brother? Ian, good morning. Lonigan, Trademaker, gang's all here. Hey, Dash. Well, just kind of holding steady here. It's Our overnight inventory is a little bit short. It corrected a little bit. We have a seller at that 64, 63 area, and we have a poor high. Our low is interesting. Our low is 68.55, and on the 4-hour chart, that 68.54 quarter, it's something I've been looking at, and that level has been working for days now. I'll bring this over and show you. Um, you could see that we had sellers here for days. We looked above it, we failed, and we looked below it, and so far tonight we're staying above it. So let's see what transpires today. It's a slow night. There's not a lot of opportunity. Um, I think if we get up over 64 and clear the 65s, we'll go back to 66, 67. That's not a lot of meat on the bone, you know, for us as scalpers, even to build a position and sell it. To make any kind of money tonight, you're going to have to put on some size. Uh, that is not a beneficial way to trade. So business is slow, right? Tomorrow is a Fed day, and nobody wants to take any risk before a Fed day. And I told you guys yesterday, and I told you guys last week, and I tell you guys every time before a Fed day that it's going to be slow, right? Because nobody in their right mind puts on risk before a Fed, right? So what are we going to do today? Okay, if it's really slow like this, are you guys going to trade and trade and trade and get frustrated and get angry, all that stuff? No, right? You got better things to do. What you should be doing now is going over your trading for the year. That's what you should be doing in December. Okay, especially during periods like this. Now, I've been working on something. I'm going to try it out here because for me to call out trades right now just doesn't make any sense. So, are you guys, and I'm talking to the folks in the room, do you guys want to go through something that I'm working on? How awake are you? Just want to double check, right? So, What I'm trying to do um, is explain time frames. Now, a lot of people ask me, well, how come the shorts just don't cover, right? And JJ, you're always saying that short covering is present in these markets. And it is. Because if you study how a market is built, you're going to have an understanding of why it trades the way it does. Now, I'm a mechanic and I put companies together and I put stocks together. Now, retail traders are unfamiliar with this concept and I don't expect them to be familiar with it. But there are some simple mechanics in trading that you should know about. Okay? You should understand the concept of time frame. Okay? So right now we just saw that we had a seller at 63.5 on the candle chart. I'm just going to show you that before, just in case people get upset. So we have that seller at 63.5 to the tick. Market's down. Let's see if it holds 60. And if it breaks 60, it's going to come back into this 58, 56 area. All right. Now, let's talk about time frames and how this market is put together. You have different people who are short at different times and different sizes. So now there will be some people, if we go back to the 25th of November, there was a gap. And when you see that gap, right, now we call a gap when a market opens outside its previous day range. And there's a simple explanation why I don't look at other gaps the same way, because this is a change in business. So if price closed here and then we open up here, there is a change in business. You cannot pay what you paid for the same day, right? You have a change in business. So that means, now does that change continue, or is it just a momentary change? Do you guys understand? Are you with me so far? Okay, so that's one thing. When you look at a market, my eye is immediately drawn to this. The lows are getting higher. As a trader, right, that means the bid is following the ask or the offer. Price is set by the sellers. Okay? They set the price to the buying that comes into the market. So if buying comes in the market, the sellers will raise the price. If we start to run out of buyers, the sellers will lower the price to get rid of inventory. Okay? Just like a store. So that's why you have these moves, right? You raise price, the sellers start to compete at these levels, and then they put the market on sale. So we like to trade from the outside in, from the outside in. Those are nice trades because you know where the sellers are, you know where they stop selling. So if you trade between those 2 points, you have a place to put your risk if you're short or if you're long. Make sense? Now, time frame is something that I've been trying to figure out how to explain it, and you guys are like my guinea pigs tonight or this morning. And I want you to understand that there are people who are short here, and there are people who are short here and here and here and here and here. So when the market did this and liquidated, it came down to people who were short 2 days ago. Does that make sense? So if you were short from 3 trading sessions ago and you're short underneath 68.20, those buyers are still there. The buyers from 68.20 to 68.34 are still there. That's why yesterday's low looked at that 34 level and came right back up and closed considerably higher. Okay? So there are different time frames of shorts. So over a swing period of maybe 5 or 6 sessions, you have, let's see, 1, 2, 3, 4, 5, 6 different sets of people who are short at different time frames. That's why you have responsive buying when the market gets down, right? So this concept is the same on a 1-minute candle chart. So what happens is if you have a bid and an ask, right? Large traders will put orders in on the bid. Okay? So let's say, for example, the bid is 5 and the offer is 505. All right? And I go to buy 10,000 shares on the bid. Maybe I get filled on 5 of them. If there is not enough supply coming in on this bid, I am forced to buy it higher at what it's offered at. Does that make sense? So if I go to buy 10,000 shares at 5 and I get filled on 5, leaves 5, I have to move that bid up, so maybe I'll go 501 to see if I can get hit. This is how trading works, you guys. You guys, you buy something and hope it goes up. What we do is we bid for something to see whether or not there's any supply at that level. If there's no supply at that level and the offer is close, we'll take that offer. And if that offer cleans out, so if it's 505 and I go into that offer and buy 10,000 shares and that offer moves to 510, right? Then I know that we've cleaned out the seller at 505. So when I use a term like we need to clean out the sellers at a level, we need to clean out the inventory that's offered for sale on the offer at that level. Does that make sense? This is very basic, rudimentary stuff that I'm going over because I always assume that people know what I'm talking about. When I go and I talk to people and I ask them questions, I figure out very quickly that they have no clue what I'm saying. This is one of the most completely simple things that if you guys don't understand how this works, you're missing a huge amount of information. And that's why a lot of you guys are trading and you're kind of lost because you don't understand what's going on. And no matter how many trading psychology classes you take or worksheets or any of that stuff, if you don't understand basic market mechanics, you're going to be in trouble. Because how can you operate a business without understanding how the business works? Right? So that's what we're going to try and do. We're going to try and teach you guys how the business works, right? So, right, you don't worry about that, Harris. Stay with me right now, brother. Okay? You don't have to count down with the inventory to be sold. That's none of your business. All you need to do, right, is to watch the bid and the ask, right? You really want to watch the ask. When the ask starts moving up, that means the sellers have seen buyers and they're raising price. So When the bid starts following the ask up, that means buyers on the bid cannot get supply that they want at the price they want. They are forced to take the ask. When the ask gets cleaned out, it moves higher. So Harris, does that make sense to you? That's all you have to worry about. You don't have to worry or count the inventory. That's not your job. You're not a market maker, right? You're a retail trader. So I'm trying to give you the information that you need to focus on, right? Those of you who are delta traders, that's what delta is happening. When the bid starts getting, when you can't get supply on the bid, traders are forced to take the ask and delta goes up. Okay? Very simple, right? Are you guys with me? Make sense? Okay. Now, do you understand how time frames work? So we have people who are short at these levels, right? You'll notice tonight's low is nowhere near yesterday's low, right? Tonight's low is around 55, right? Yesterday's low is what, 68.34? We are nowhere near that low. So what does that mean? Immediately you know that the bid is up here. Exactly. Exactly, Ian. Right? That is exactly it. Because when that bid is there and it's 2 to 3 days old or a week old, that means that's a size participant. Because to hold these contracts for 2 days, you've got to put up insane amounts of capital. You can't, because the futures contract requires a lot of margin to hold it in a swing time frame. So those bids, right, you'll get a bigger reaction. Now, what happens, Ian, if we get down to this level? Like, say we got down here yesterday and there was no reaction. What if we just went like this? What does that mean? Well, it means the traders who had their buy orders here, they had what we call a lookout bid. Okay? A lookout bid is, say I'm short, I will put 100 contracts at every tick, and if that first 100 gets filled, then I know that the second 100 I can probably get, and if the third doesn't get filled, then I have to move my bid up. But if all 300 contracts get filled instantly, then I can put my other bids down lower and move them down. And now you have software that does that automatically, so you don't have to manually change your orders as a large trader. They have algorithms, and it'll just drop the bid down and the price will go like this. That's why you look for the reaction at a level. And the same thing happens on a 1 minute candle chart too. It's the same thing, right? The business is the same no matter what time frame. Okay? So let's go and take a look at the TPO chart and you'll see once again yesterday same deal, right? M period opens, goes down, cannot take out the previous day low. And then the move is all the way back up, right? From 40 all the way up. Then N period opens. That's like 4 o'clock. Can't get underneath 53. Comes back over our 54 quarter and rips up all the way and closes up here at 64 half. So where are the shorts trapped from close of business yesterday. They're trapped under this M low. This N is in Norman. That's why the overnight low is there. That's why the overnight low did not transact 54 quarter, because anyone who's short here from after hours is bid to cover and they're moving the bid up. You see that? Does that make sense? When you walk through a market, you should be able to figure it out. If you can't figure it out, ask me. If that level breaks at 53, the next level we're looking for is 40. And that's why I always say if that breaks, you're looking for this, because that's where the next set of bids are. Here in this area, I have no idea what's in here. We could stop anywhere here, depending on if those lookout bids here, if they see that if I have a bid for 100 here and 100 here, and they don't get filled, I'm going to move my buy orders up. If they get filled, I'll move my buy orders down. That's how traders trade, right? They don't look at fibs or anything like that. They use their orders to tell them what kind of business is taking place. That's why when you're trading and say you're long, so say you're long at 5, right? Exactly. Say you're long at 5 and you buy 1,000 shares of something, right? Put your sell orders out. Right? Put your sell orders out. K high is an obvious place, and thanks for pointing that out, because when M period took the high of K, there will be some trapped shorts here as well. Great observation. Right? Nice one. Someone's had their coffee. Beautiful. Right? And that's why you'll see there'll be certain times where there's buying. See, like where O, N and O period, this little area here, that's why that X low came here and stopped. Only later on in the session did it break that and came back up over that. It's the same thing. So when a market takes a level out to the upside, there'll be shorts that are bid there. And that is another time frame of shorts. So you have shorts trapped at this time, and at that time. Those shorts have been filled partially. Okay? Partial fills here. Okay? And the market has rotated all the way back up to the close. This is what I'm trying to get to with time frame. Okay? Time frame is important. This will just kind of be this is like the first test video to see if you guys are understanding. Now, how do you use this, right? Well, if you're a short seller and you were shorting the market, say you were short 63, just, right? If you were short 63, where would you look to cover? If you were short 63 and it comes down and it takes out that X low, you know that there's going to be some bids, there's going to be some kind of buying in this area here. So you'd put your buy orders in there and see if they get hit. And that's the simplest way to trade, because you're not looking at 300 different things, right? If you can keep a semblance of reality in your head, right? Because it's a business, right? No, Howard, it doesn't, because you're not trading on a weekly time frame. But you need, that's why, do you know, Howard, how I do the same thing every day? Right? I go in and I look and I see overnight inventory short. I go and look at the lower stops. So if we got down to the previous day low, then you would pay attention to that low here. You don't need to mark up your charts. I'm just trying to make you aware, right, of where things are. right? So if we broke that low, then you'd go and go, okay, look, that low here that's the next one, right? Because here's the deal. If you take out this low, right? No, just do it for just do. You don't have to change anything, right? In the method I taught you, you don't have to change anything. All you have to do is just be aware, right? So if we take out that low, then these people, these people, these people, and these people who are long are more likely to sell because the swing longs will be using that as a level, then that one, and then that one. There you go, right? So we've had inventory correct of Friday's inventory got corrected yesterday, and we're already sort of back up, right? Now, two things will happen on an inventory correction. One is that we take the weak-handed people here, right, or day traders and stuff, and we flush them out, right? Anyone who's long here, we flush out. The second thing we do is we create a short position here because the smart money comes in and covers. The dumb money gets short at yesterday's low looking for this. When that doesn't happen, you get that. It's the same on every time frame and it never changes. It's always the same. The business never changes. You'll hear people talk about algos and all this stuff, and it's all just, they don't know what they're talking about, right? The algos don't run the market. The algos are basically robots that automate the trading process to make it more efficient. That's it. Well done, Howard, right? That's all it is. It's just more efficient. What are they making more efficient? The process of delivering inventory, right? It's like you go to the store and there's a warehouse, you type in what you want, a robot goes into the warehouse, pulls your order, like say you're buying, I don't know, you're buying a tablet or a computer. It goes back into the warehouse, grabs that, and pulls it out and brings it to you. Yeah, well, people, Ian, will always say something is manipulated if they don't understand it, right? And what manipulation is, it's a cop-out, right? It's an excuse made by people who unfortunately aren't successful at what they're trying to do. The reason is they haven't put in the work, or unfortunately, the reason is they haven't got good information. That's why we, as I segue here into our AI, right? Our AI trading coach, right, is a source of proper information, right? And our trading room is a source of proper execution. So you need good information and you need good education and execution to put it all together, right? And for the folks who are watching us on YouTube, right, come join us at thetradingsyndicate.org and check out our AItradingcoach.org, right? We are at the forefront of helping you get good information and learning how to execute, right? So you can make a living. That's all we're trying to do. Very, very simple, right? Because trading is a business of repetition. Once you understand that trading is a business of repetition, you look for the same repetitive business transactions, the repetitive business cycle, and once you got that, you're golden, right? Then it's just a matter of reps. right? Are you going to get stopped out? Of course you're going to get stopped out. That's a business. Getting stopped out is a business expense, right? It's not a reflection on your moral character or your intelligence, right? Sometimes you're in the wrong place at the wrong time. Sometimes it could be a stray order. Sometimes you're too early. So all of those three things I just said, you want to use those to manage your business. You get feedback from the market and you manage your business accordingly, right? So if you're getting stopped out a lot, you need to stop and look at your trade entry. Right? Now, we are going to take this and see if we can take out that overnight high, which is a poor high. Right? It is a poor high. And the upper stop now is that C high, which is right at 68.70. It's a repeating cycle, my friend. That's all it is. It's a repeating cycle, and it is the acquisition and distribution about of inventory. That's why they call it a market, right? Otherwise, they'd call it, the stock sauna or the stock hot tub or the stock oven, right? It's a market, right? But what is the business of a market? It's to distribute. It's a mechanism to distribute, in this case, investment products, from the smart money who creates them to retail or whoever is buying. We don't care who's buying. As long as somebody buys, that's all we care about. We don't care who it is. Above the close, it's a slow night. There's not going to be a lot of follow through. So if you are long, remember that. You might have to sit in the trade for a while, right? Knowing that, look, when the market was doing this here, right, down to here, back up here, and now we'll try and take all of this stuff and sell it here. We'll sell it wherever they're willing to buy it, right? Because if you're long anywhere under 63, heck, you'll take 65 for it on size. Any questions? I'm glad that's working for you guys. I'll keep trying to refine, I'll keep trying to refine this stuff. So you got to just remember that there are multiple time frames of bids, especially when you have a market that's trending up. Thanks, Ian. Cool. And if you have any questions, just ask. Really want to make sure that I prepare you guys this year for what's coming next year. Because I think it's going to be an interesting year. I want to do a lot of focus on execution too, but sometimes these markets are so slow. It's kind of hard to execute when it's so choppy and slow. I think it'll get better after the Fed. After this Fed day, I think things should hopefully start to get a little bit more active as all the Christmas traders start getting froggy, right? They need to make that money, right? There's always some kind of action. Yes. Yes, Jiraj, they are. It is. You're right, Moran. It is difficult to ask the right questions. But that's why I'm like, ask whatever questions you want. And if you don't understand, don't be afraid to say you don't understand. You're not going to insult me, right? And don't feel bad that people will look down on you or any of that crap. Because really nobody comes into this business just knowing exactly how it works. Even guys I know, like even my friends whose fathers ran trade desks, I honestly saw when they started in the business, they were really at no advantage to anybody else. They were still, they still had trouble. So don't worry about that. Ooh. So now we know that there's a seller at 66. And I was up at what? Oh, man, what time did I wake up? I was up at 5 in the morning, 4:35 in the morning, and I looked and we were at like just 30,000 contracts. So in the last couple of hours, 3 hours, we've only traded 3,000 contracts. Barely. It does. It takes a little while. And this whole business with this point of control moving up or down just means, are we distributing? So the point of control now is at 62 and a half. Can we get it, like say we take out 70, can we go and move it up here? And that shows good distribution of our inventory, right? Well, we're not that far away from all-time highs, so it's not, your statement is not outrageous. The liquidations that are happening in this market are we haven't had a serious liquidation for a while now. And every time we do have a liquidation, this thing pops up. Like when you hold a beach ball underwater, it pops right up. Boing. Right. Oh, thanks, Lake Show. I mean, I could see, first of all, let me remind you that um, the new contract, right? The new contract is trading at 69.23. Okay, so right, the H26, right? EPH26, that's trading at 69.23. Now it's only traded 1,600 contracts tonight or this morning, but so when we roll, we're gonna be, you know, if you adjust the highs, and I'll do that. There's a rollover video that's posted in the room too to help you with that, with contract rollover. Hey Tim, have a good one. We'll see you later. Oh, okay. You're Jack. Okay, cool. You guys all have different names on Twitter, YouTube, that kind of thing. So yeah. So I'm the reason I talk about this stuff a lot is because my role, like they say I was a market maker and stuff like that. Well, I actually gave the market makers the order flow. And the order flow was because I was the guy who had the supply. So that's why I know about selling supply, right? Yes, there will be an execution 101 this week. Um, Probably have it tomorrow. I think Wednesday's a good day. And it'll be recorded for those of you who have to work. Different time zones and stuff. This is one of, like, before Fed days, this is one of the more frustrating. Now, let me talk about trading psychology a little bit. Okay. One thing that's going to help you guys with your trading psychology is if you understand what's going on in the business, your level of frustration will be less. Because if you came in and you looked at this chart right now, right, immediately going and looking at that 1 minute chart without even looking at the TPO, you're like, oh man, this is a tight market, right? As soon as you see this, what I want you guys to do is I want you to relax. So when you see stuff like this and these candles like that, right, you immediately, your blood pressure should drop about 40 points because you know there's nothing to do here. And if you know there's nothing to do, you're not going to take bad trades, right? If you don't take bad trades, you don't need to worry about trading psychology because your psychology is great. You know not to take a bad trade. Seems simple enough, doesn't it? So you don't have to worry about all of those things that people freak out about. Because if you're relaxed and you go, oh, they're just doing this now, right? Yeah, you're like, oh, okay, they're distributing, the candles are really small, there's no follow through. Maybe I'll go hit the gym now. Or maybe I'll go and review my last trades instead of worrying about chasing trades. So when you're chasing a trade, right? And I'm not a psychologist, so, you know, but you're in that fight or flight sort of mode. And your adrenaline's up and you're trying stuff and you're trying stuff and it doesn't work. And then you're trying stuff and you're trying stuff and it doesn't work, right? And that is horrible on your mental health because it feels like you are not good at it when you're just doing business at the wrong time. So do you see how much simpler it is to go, oh, this is not the time for me to do business, right? So I could just kind of relax and wait for the market to say, okay, it's time to do business. Exactly, right? We want you to get comfortable. Now, of course, that comfort comes from repetition. But at least if you guys have a heads up on when you should be dialed in and all serious and when you can kind of just relax, make some notes, look at other levels, plan out trades for the, you know, it's going to help you. It's really going to help you. That's great. So Joe, if I told you right now, right, we can do an exercise on that and we'll do that in the execution class too. So what you should do is say I go 68, 65 bid, 64 stop. Those orders should be in, right? By the time I'm finished saying where the stop is, you should have that order in. Practice putting it in right away. And then if you get hit, like say I'm buying 66 and a quarter and my stop is 65, just for example, as soon as I get hit at 66 and a quarter, I should go and put some 67, 68 offers in. As soon as you get hit on the bid, go offer it out. Because how do you know if anybody wants to buy your stuff if you don't have an order out? And that's okay to fumble around, Ian. We all do. We all do. Good stuff. Just keep practicing it over and over so you know the key sequence, right? In the old days when we used to trade on the phone, the head traders would just throw stuff at us, right? They'd take a trading ticket, make a paper airplane out of it, and wing it at our heads, right? Or they'd yell out orders. I still remember my first week on the desk, one of the old floor traders came up to the trade desk and started doing hand signals. And I was like, what are you doing? I wasn't on the floor. I don't know the hand signals, right? He was screaming at me and he's waving his hands. uh, Even if you're a swing trader, if you're trading options, whatever you're trading, you should know your software intimately and you should be able to place trades and it should be like breathing, right? You shouldn't be fumbling around on the DOM or whatever you're using for execution, right? You should know it intimately, right? Those are your tools, right? We're slowly creeping up here. Is what all the same? The software? The execution? A lot of different software companies out there, KM. Some of them have trading DOM, some of them have chart trading, some of them have like a little order execution panel. They're all very different. So whatever you're using, you want to be proficient at it, right? The whole thing is to delay the hesitation, right? The hesitation comes from not knowing when to trade and also fumbling around in the software, that kind of thing. We want you to get comfortable, right? Then it's just a matter of doing it over and over and over and over again, right? Yeah, it's muscle memory, right? Very good. Very good. So I'll just put this in. So I'm just typing this out. Yeah, volume analysis is okay, but it's really overrated. All you need to do, I'll tell you something about volume analysis, right? Do you understand why you're looking at volume analysis? You're trying to look for the position. So this is the position here, the blue stuff. That's distribution of the position. That's when you put the position on sale, and that's when you distribute it higher. So if you watch these blue areas, that's where the cost basis is. That's all you really need to know. There's a lot of stuff written about volume analysis which isn't actually going to make you money. It's cool to look at. I don't know a lot about it is true because unfortunately, a lot of the people who teach volume analysis, and I'm saying this with as much respect as I possibly can say, a lot of the people who teach volume analysis have not traded volume. So how the hell are you teaching people about volume analysis when you've never traded a million shares aside? If you've never worked a 500,000 share sell order or a buy order, what gives you the the experience to teach people about volume analysis? I don't know. I'm just saying, right? If you're teaching something, it's something that you should have done, right? Doesn't that make sense? Right? Like there's a lot of people, and nice people too, and I don't mean to be disparaging, but if you've worked, if you've worked at in the business and you've been on a trade desk and you've moved, like like how could you teach people about volume analysis when you've never traded more than one or three contracts or 500 shares of a stock? Or we've got a seller at the overnight high, right? No big surprise, right? There's some very, very sweet people out there who teach volume analysis, but they wouldn't know a trade desk if they tripped over one. They wouldn't know how to work out a million share order if their life depended on it. So they give you all this information that is absolutely worthless and that you'll never make money on. Here's the thing, and that's why we had a gentleman on here yesterday. They were talking about the float and the dollar volume, and I'm like, just look at the chart. The chart tells you everything you need to know, right? The chart tells you everything you need to know. The chart is the only accurate description of the business transactions that are taking place. Right? So you're better off looking for where the buyers and where the sellers are on a 1 minute candle chart than volume analysis or footprint charts. Because most people I've seen who trade on footprint charts and teach footprint charts and volume analysis, when I listen to them, I'm like, dear God, how do I say this without being rude? You have no freaking clue what you're talking about. And then the people who follow them into trades, they'll notice, well, this is not working, right? Friday's poor low. You know what, Raj? I never even thought about that. Yeah, it is resistance right now, if you look at it. Yeah, you're right. As soon as we get up into Friday's range, there's a little bit of inventory up there, right? And the thing is, Raj, there's not much follow through buying yet, right? Because it's such a slow night, there's really no reason to raise price because we don't have a ton of buyers in, right? So be careful on who you learn from, right? And I'm not saying there are plenty of good educators out there, but if they've, if you ask them, here's what you should ask your trading educator. Number one is, you're telling me to take a trade. Can you explain to me the mechanics and the business reason for taking that trade? Can you please give me the business reason why I should take this trade? Can you give me the business reason why the stop should be at where it is? And can you give me a business reason on where my target should be and how I should manage the process? If they can't explain that to you, they shouldn't be teaching, right? If they can't tell you that the volume indicates inventory and position, if they don't use words like inventory and cost basis, they're not real traders, right? And if they're trying to tell you that large traders are bid here and they're iceberg orders here and all of that stuff, and they've never traded a size order, they don't know what they're talking about, unfortunately. You know, it helps if you get good information. It also helps if you just worry about execution and just keep everything simple, right? I would suggest just a 1 minute chart, and you should be able to look at a 1 minute chart and go, oh, there's a seller here, there's a seller here, there's a seller here. Do you see how the sellers step down from there to there to there? Well, that's a shorting opportunity, right? Once the sellers start raising price, you know you shouldn't be short. If the sellers are lowering price, then you can short. So very simply, here, we knew that there was going to be a seller. Yeah, it's just simple, right? So you short a little bit here, you put your stop here, and then you put your bids down here near VWAP. Because you know that there's going to be buying at VWAP. So really simple. You don't have to be a rocket scientist. Oh, there's a seller. Let me sell with them. Right? See, the reason for this, in the old days, if, say, I'm sitting next to Joe on the trade desk, and Joe gets an order from his client here to sell 1,000 contracts. And I know that Joe's sell order is going to push price down. I'll go to Joe, hey, Joe, can I sell alongside? So I'll go and I'll sell 10 or 20 contracts short at 67. I'll put my stop above this candle just in case Joe's client cancels the order, because that does happen. So I'll short 20 contracts, he'll say yes, and then he'll start selling. He will knock the price down. I'll put a buy order here. I'll short 67. I'll cover 63. I'll take those 4 points on 10 E-minis, and I'm buying drinks tonight. Do you guys understand the business reason of that trade? I know that he's got a sell order for 1,000 contracts, right? I ask him if I can sell with him. He allows me to go sell 10, 20 contracts and hit it out here. Then he sells and pushes price lower, right? Or he's selling alongside me, right? I know that there's going to be responsive buying at VWAP, so I cover before VWAP and I take in 4 points on 10 to 20 contracts. He can do whatever he wants, keep selling whatever the client demands. But that's what you are doing. When you see a seller, you ask the market, can I sell alongside? You put your stop above where the sellers interact. It does not get any more simple than that. That is your risk. And that's why you're shorting. You're not shorting this. You're shorting the back end of the move when the seller reveals itself. Does that make sense? When the sellers reveal themselves and when the sellers start lowering price, that is your indication to sell short. Your stop is above where the sellers initiated. Because if that seller cancels that order or if that seller sees a lot of buyers, they're not idiots. They're going to move price up. So you don't want to be caught when price is moving up. It does not get any more simple than that. That's how people have been doing it for thousands of years. You don't need waves or fibs or anything. You don't need to correlate markets. Do you see the simplicity of this way of doing business? Very simple. Is it easy? No, it's not easy, but it's simple. So if you keep your analysis simple, you can focus on your execution. And when you focus on your execution and you make good business decisions, your trading is going to improve considerably. Okay? And that's pretty much it. And I've kept you guys a bit longer. Thanks very much. Hopefully this has been helpful. And for the folks who are visiting us on YouTube, come see us at the Trading Syndicate. Use our AI trading coach. We'll teach you how to make money. No gibberish, right? Just work. Okay? Thanks, everyone. Have a great morning, and we'll see you at 9 o'clock Eastern Time for our next session. And if anyone is interested in one-on-one lifetime mentorship, please reach out to me. I am taking new students, and it's basically one-on-ones for life until you're profitable or until you open up a hedge fund and give me a job. Thanks, everyone. Stay out of trouble. Don't take candy from strange market makers. We'll see you in a few hours. Thanks for being with us. Bye for now.